Chapter 3, Internal Auditing. What is internal auditing? Now, the word audio means hear or listen. The word auditor refers to someone who studies the financial position of the business by looking at the financial statement and by listening to the explanations thereof in order to give an opinion as to whether the information is reliable and trustworthy. Now, to audit something means to check if it is accurate and correct. The following, among other things, must be checked during an internal audit. Have the accounting principles as prescribed by GAAP been applied? Have the prerequisites set by, for instance, the Tax Act been adhered to? Have different internal control measures been applied throughout? Have economic empowerment standards been adhered to? And have international financial reporting standards been applied? Now, the role of the external auditor. This is very important that you distinguish between an external auditor and an internal auditor. So, in the modern times, the auditor has played an increasingly important role. The owners of the business do not necessarily manage their own businesses, like, for example, in the case of shareholders in a public company. The directors of the company are responsible for the processing of financial information and the interpretation of financial statements, which are then presented to the shareholders. So the shareholders will therefore require assurance as to whether or not the financial information can be trusted and relied upon to make their own decisions. So the opinion on the reliability of the financial information must be given by an externally qualified person who is not part of the business and can express an independent opinion. Such a person is referred to as an external or an independent auditor. So after the completion of the audit, an auditor's report is compiled by the external auditor and is made available to the relevant parties. The opinion expressed by the auditor's report may be positive, negative, or have some conditions. So the external auditor will give one of the following opinions regarding the financial statements. A qualified report, which means that there are some recommendations or change regarding the statements and the information in the report because everything is not reliable and true. You can remember this by saying they want to qualify some areas. In other words, they want to highlight or point out some areas that need attention. Unqualified report, which means that all statements and information provided were correct and no changes or recommendations needs to be made. This is obviously the report that everybody wants. Unqualified can be remembered as saying they don't need to highlight any matters. There's nothing to qualify, so it is unqualified. They don't need to point out any mistakes. Everything is as it should be. The third one is an opinion withheld, which means that the statement and information do not adhere to the standards at all, not reliable, and must be redone in full. This is a very bad report. So there are basically 5 parties who will be interested in the auditor's report, namely, first and foremost, the shareholders. Secondly, the government, such as SARS. Thirdly, any prospective investors. Thirdly, creditors. And fifthly, financial institutions. In the next video, we will look in more detail as to what is the difference between an internal and an external auditor.